Hello everyone and welcome back to Explain the Charts, your go-to channel for no-nonsense market analysis. Today is October 1st, 2025, and we are diving deep into Ethereum, which is at a very decisive point right now. The headlines are painting a chaotic picture, with significant bearish news battling underlying bullish sentiment. On one hand, we've seen reports of the ETH price plunging below the critical $4,000 mark, triggering a massive $45 million liquidation for a single whale investor. This downturn is being linked to broader macroeconomic fears, including a possible U.S. government shutdown, which has caused widespread fear and a sharp decline in Ethereum ETF inflows this month. However, the story isn't entirely bearish. Despite the volatility, major players are still showing strong interest in Ethereum for the long term. We have reports of significant institutional moves, with BitMine now being the largest corporate holder of Ethereum, and analysts like Tom Lee calling ETH a discounted asset poised for major adoption. Furthermore, on-chain data shows that while some leveraged traders are getting liquidated, large wallets have been accumulating huge amounts of ETH, spending over $1.7 billion in just a few days last week. This suggests that long-term investors, or whales, may be viewing this price drop as a buying opportunity. This creates a fascinating conflict in the market: short-term panic versus long-term confidence. Now, let's see how this dramatic news backdrop translates to the price action on the charts. Here on the daily chart, looking back from September 1st, we can see the story of this recent downturn unfold. After peaking in late August near $4,800, the price began to show signs of weakness. The first major crack appeared on September 22nd, with a sharp drop from around $4,450 to nearly $4,200. But the real damage was done on September 25th, which you can see on this large red candle here. The price broke decisively below the $4,200 support and plunged all the way down to a low of $3,825. This perfectly correlates with the news headlines about the whale liquidation and market panic. Following that drop, we saw a relief rally, with buyers stepping in to push the price back above the psychological $4,000 level. The price then attempted to reclaim its prior support zone, pushing up towards $4,250 on September 29th. However, sellers met the price with force, and it failed to break through, signaling significant overhead resistance. This failure to continue the bounce was a key bearish signal. It showed that the sellers were still in control and that the recovery lacked conviction. The price then bled down over the next day, closing at $4,145 on September 30th. This setup of a lower high after a major support break is classic technical weakness. And while our chart data ends there, we know from today's news that this weakness has continued, with the price once again falling below the $4,000 mark today, on October 1st. Now let's switch to the 15-minute chart to get a closer look at the price action following that big September 25th crash. This chart picks up on September 26th and shows the anatomy of that failed recovery rally in detail. We can see the initial push off the lows as the price climbed back above $4,000. The momentum carried it upwards in a choppy but steady trend over the next few days. The rally culminated here on September 29th, where the price peaked just shy of $4,250. Notice how the buying pressure fizzled out at this level. The candles became smaller and started to turn over. This was the key inflection point where sellers retook control of the short-term trend. What followed was a steady decline, with the price making a series of lower highs and lower lows. This grinding downward action eroded buyer confidence and erased a good portion of the recovery gains. By the end of the day on September 30th, the price had fallen back to around the $4,145 level. This short-term price action clearly shows the bulls losing steam at a key resistance level, setting the stage perfectly for the next leg down that we've reportedly seen today. Switching back to the daily chart for the bigger picture, let's recap what this all means and what to look for next. The market is currently in a state of short-term fear, and the price is reflecting that. The trend has clearly shifted downwards from the August highs, and the critical $4,000 level is now the primary battleground. Let's summarize the most important price levels to be watching right now. Immediate resistance is the zone between $4,200 and $4,250, where the recent bounce failed. Above that, we have a larger resistance area in the $4,400 to $4,600 range. The ultimate near-term resistance remains the recent peak around $4,800. To the downside, the line in the sand is the recent low of $3,825. This is the most critical immediate support level. If that level breaks, we should expect a move down to the next major support zone, which technical analysis and news reports place between $3,500 and $3,600. This area represents a prior consolidation zone and a key Fibonacci retracement level. Below that, a deeper correction could target the $3,200 level, and in a more severe downturn, the 200-day moving average, which sits near $2,920. So, what are the potential scenarios? The bullish scenario, which I would give about a 40% probability in the short term, requires buyers to step in with force and reclaim the $4,000 level. For this to be convincing, we'd need to see it hold as support, followed by a break above the $4,250 resistance. This would be reinforced by positive news, like a halt in ETF outflows or strong signs of whale buying. The bearish scenario, which I see as having a 60% probability for the immediate future, involves the price staying below $4,000. In this case, a retest of the $3,825 low is highly likely. If selling pressure continues and we break that low with conviction, a slide towards the $3,500 to $3,600 zone becomes the most probable outcome. Long term, the picture remains more optimistic due to the strong fundamentals and institutional interest we discussed earlier. This pullback, while sharp, could simply be a much-needed correction before the next major uptrend. However, for the short-term trader, the momentum is undeniably bearish right now. The key things to watch are whether support at $3,825 holds and whether bulls can mount a convincing rally back above $4,000. That's all for today's analysis on Ethereum. Thank you for watching Explain the Charts. If you found this breakdown helpful, please hit the like button, subscribe to the channel, and let us know your thoughts in the comments. Stay safe and trade smart.